Hello my beautiful people, welcome to my YouTube channel. Have you ever wondered why some businesses are unable to know how to finance and run their businesses successfully without having problems of finance? In today's video, I'm going to be showing you the relationship of capital and liability, which are the sources of finance to a business. Before I continue, please don't forget to like, comment, and share this video. And if you are coming across this video for the first time, please do well to subscribe and turn the notification bell on. Thank you. The first thing we need to know is what is capital and what is liability. We have these two sources of finances in a business. The first one is capital, which represents the financial resources of a business to fund its activities. That's the financial resources of a business to fund its resources. And this capital is divided into two: the equity capital and the debt capital. The equity capital represents the owner's investment put into a business by the owners of the business to fund the business. It represents what the owners have saved for the past periods for their personal savings, and they have decided to bring it up to save to start a business. So this we also have retained earnings, which is the undistributed dividend or the undistributed profits to a sole trader, which is used to reinstate in the business to run the business. We also have the debt capital, which refers to the borrowed funds that the business has borrowed from somewhere, which is supposed to be repayable with an interest to run the business. This includes debentures, preference shares to a joint stock companies. When they talk of these types of capital, which is divided into equity capital and debt capital, this is solely to a joint stock company. But to a sole trader, you have the personal capital, which is the initial sum that the sole trader has been saving to start up a business with. And then the next type of finance, which is important as well, is the liability. Liability here refers to those debts that the business is owing to others, and they are supposed to pay back. It is divided into non-current liabilities and current liabilities. Current liability is also known as short-term liability, which are the debts that the business is owing and they are supposed to pay within a year. Example here includes suppliers, short-term loans like overdraft, taxes owed, accrued expenses, prepaid revenue, and so many others. Then we also have the non-current liabilities, which is also known as the long-term liabilities. These are debts that the enterprise owes, and they can pay these debts above a year. They have to pay. The debt should be repayable after a year. That is, the debt is supposed to be due after a year. It includes long-term loans, bonds payable, lease obligations, mortgages, and others. These are the resources of a business. Before venturing into a businessman is supposed to know how this business is going to be financed. Is it going to be financed more with debt capital, more of liability, more of equity capital? It is very important to know this. And once you know this, you'll be able to run your business. Take, for instance, a business which is financed more with debt capital. Remember, debt capital is liable to interest. You are supposed to pay interest to this debt capital. And now you decided to borrow capital from a source like using debentures. Also liabilities. Let's take liabilities like long-term loan. You know that with this type of finances, the cost is usually very high. So if you are starting a business and you decide to take a loan from the bank, and the loan is going to be more than your equity capital, or you are financing it with a debenture which its interest is more than the equity capital, which the debenture is more than the capital, you should know that these sources are going to cost you. And since they are going to be very expensive, or let's say you are going to incur some expenses when during the repayment of these sources, you are going to lose money. And in the course of losing this money, it may be the profit that the business was supposed to make. So you will see that you are going to just be suffering, and the business is not going to actually work. And then we need to also see the relationship between this debt capital, equity capital, and liability. So we have capital, liability. Using a balance sheet, the relationship is simply assets equal to capital plus liabilities. Assets equal to capital plus liabilities. These are the various sources of funds, which is equal to the uses of funds. And now, in a capital structure, to get the relationship, we are going to take debt capital is to equity capital. That's when we want to look at the relationship using the capital structure. We are going to just talk about capital gearing, which is the relationship of equity capital to debt capital. And this relationship, it can be expressed as a ratio, can be expressed as a whole, can be expressed as a percentage. And of course, it can be highly geared or lowly geared. Thank you for watching. Thank you for staying tuned to this time. Please, I'm going to take a practical lesson to show you how the capital structure works and how to finance a business. Please stay tuned. Don't forget to like, share, and comment. And if you are coming across this video and you have stayed to this time, thank you very much. I love you all. Please stay tuned.